Hi, I'm Rob. Welcome to my AT&T stock analysis video. This is my 4th stock analysis video and my 9th video overall. Before analysing the fine details of the company, we first need to know what the company does. For my US viewers, this might be very obvious, but not so much to my UK or other viewers. First of all, the company can be split into 3 branches. They are Communications, Latin America, and Warner Media. Communications is by far the largest branch, with total revenue in 2020 being $138 billion. That is just under 80% of the total revenue. Next is the smallest branch is Latin America, with $2 billion in revenue and a negative $0.73 billion in operating contributions. Last is Warner Media, with $30 and $82 billion in revenue and operating contributions respectively. We will focus on this branch later on in the video as there is a planned spin-off from the company. The communication branch can be broken down into 4 segments. They are mobility, video, broadband, and business wireline. The mobility sub-branch added 17 million new subscribers, taking their total from 166 to 183 million, representing a 10% growth. The 17 million new subscribers is also more than 14 million new subs in 2019, representing a 21% increase. AT&T's premium TV and TV Now products continue to decline as seen over the past few years, with net additions being negative 3.3 million. Broadband had a negative 19,000 net additions. However, high-speed fibre had over a million net additions as customers transitioned to newer, faster fibre, which is more expensive and provides a higher revenue per customer. Lastly is the business wireline sub-branch, which had a 3.1% decrease in revenue from 2019's revenue. As you can see, mobility was the only communication segment that had revenue growth in 2020, and the same is true for 2019 compared with 2018. Next is Latin America. As mentioned, it's the smallest branch of AT&T. As they operate in foreign countries, they can be impacted by exchange rates. This could be negatively or positively. 2020 was a bad year for the Latin America branch, with revenue declining just under 18%, double the decline seen in previous years. Next is the Warner Media section, which will be the main focus of the remaining video, as AT&T are planning to spin off Warner Media section of the company into a new company. Warner Media is currently made up from Turner, which primarily operates multi-channeled basic TV networks and also sells advertising on the networks. Home Box Office, or HBO, which makes massive shows like Game of Thrones, with the spin-off House of Dragons coming next year, The Wire, The Sopranos, and Band of Brothers. The biggest sub-branch being Warner Bros., which also make TV shows as well as movies like Edge of Tomorrow, American Sniper, along with Christopher Nolan films such as Inception, Tenet, The Dark Knight, and Interstellar. Unfortunately, it was announced in September that Nolan is leaving Warner Bros. After 19 years. Last sub-branch is the advertising business along with other small ventures. So how have these sub-branches performed in revenue? Turner produced $12.6 billion in 2020, HBO $6.8 billion, Warner Bros. $12.2 billion, and elimination accounting for negative $1.1 billion in revenue. So Turner and Warner Bros. Have a very similar level of revenue. Warner Bros. Saw a fairly significant revenue decrease of 15.4% in 2020. Looking closely at the numbers, it shows that a large majority of the decline was due to the theatrical products performing poorly. Now, of course, the cause of this is fairly obvious, which nicely brings me on to the next section of the video, which is the effect COVID-19 and the government lockdowns has had on AT&T. Now, without a doubt, COVID has a massive impact on AT&T. As mentioned, it directly affects things like Warner Bros. Cinema releases, delays, and lower numbers of customers going out to cinemas in 2020 has obviously affected revenue, with this segment having a 22.6% revenue decline when compared with 2019. That's $1.6 billion less in revenue when only focusing on one small segment of the business. The total impact was estimated at just under $3 billion, or 33 cents per diluted share, a fairly large but not devastating impact. So what caused this? COVID caused a reluctance of customers to travel, causing reduced revenues from international wireless roaming services, with little expense reduction in this area. Next is the partial closure of movie theatres and the postponement of releases. Lastly is a break in production of new TV shows. AT&T believe these three issues will continue in 2021, but will be reduced as the economy reopens. So how has AT&T performed over the past 5 years? Well, pretty awful in terms of share price. They're at a current 5-year low for the stock, even lower than the low point of the COVID-19 sell-off in March 2020. AT&T continues to suffer large share price losses, having declined 18% in the last 3 months alone. So have shareholders been totally destroyed for holding on? Well, the one redeeming trait for AT&T is their dividend payments and their yield. AT&T is currently sitting at a ridiculous yield of 8.86%. AT&T has had a high dividend yield for a long time, not dropping below 5% since 2017. This is what a lot of people are fixating on at the moment, is how you can get such a high dividend yield. Here's an Instagram post from a random account I saw. It shows how much of these companies' stock you need to buy to receive $1,000 in dividends a year. But it's so misleading. AT&T are cutting their dividend in mid-2022, so they won't even get the amount. And I also feel that showing off the yield of 8.87% is pointless, when it's clear that they're making quite substantial dividend cut. Yes, you would get that yield for the next few dividend payments, but you wouldn't get the full $1,000 a year. Now, if you watch my past stock analysis videos, you know that I like to combine the share price with the dividend payments to get a graph of total return. I did this for my GSK video, which showed a slightly better picture than just the share price alone. So here is the share price over the past 5 years, quite a strong downward trend. The orange line here is total return when dividends are added to the share price. As you can see, a high dividend yield above 5%, which has paid out over $10 in dividends in the past 5 years per share, isn't enough to help the poor share price performance. Here's a comparison of total return of AT&T and S&P 500 index, as well as another index focused on communication services or companies similar to AT&T, and it shows that both have had much better returns than AT&T. Revenue has been pretty stable over the past 5 years, with a little bit of growth. Net income is pretty all over the place. 2020's loss was of course caused by the pandemic. Free cash flow has generally been growing over the past 5 years, with a small decrease in 2017 and 2020 compared with previous years. 2020's free cash flow is 62% higher than 2016's, averaging a growth of 12.4% a year. As we can see, that dividends are well covered by free cash flow, and they are increasing every year. Dividends have increased an average of 5.3% a year. So now we've had a company overview and seen AT&T's past performance, both in share price and financials. What does the future hold for AT&T? Because the share price seems to tell a much gloomier story than their financials. As mentioned earlier, AT&T is planning to spin off their Warner Media branch into a new company. Here's what the new company will look like. Obviously, part of it will consist of the Warner Media branch, with $30 billion of revenue and $8.2 billion in operating income, bringing a large catalogue of movies and TV shows. The second part of the new company will be made up from the company Discovery and their Discovery Plus product. They bring with them $10 billion of revenue and $1.2 in free cash flow. Here's a summary of what the two companies together will be able to offer in terms of content. It's quite a wide range. They're hoping the combination of the two companies will allow them to compete with the likes of Disney Plus and Netflix. So what do current AT&T shareholders get out of this deal? They get 71% of the new company's shares, with the remaining 29% going to the current Discovery shareholders. The deal is expected to close in mid-22. The new company would take on the debt of Discovery, around $15 billion. AT&T will also receive $43 billion from the deal. This will likely be them moving debt to the new company, which is like receiving $43 billion in cash in terms of their balance sheet. What will AT&T look like post-demerger? Well, as mentioned, they'll have around $43 billion less in debt, with AT&T's net debt sitting around $180 billion. As a result of losing the Warner Media branch, they will have a reduced revenue and free cash flow. As a result of this, AT&T will be planning to cut their dividend after the deal. This is a massive deal for most current investors. AT&T is known as a dividend aristocrat as they have been growing their dividend for 35 years, and this will mark the end of it. Most dividend investors sold on the news of a dividend cut. Here's what the cut entails. Current yearly dividend is $2.04. AT&T has come out and said that the slimmed down AT&T will pay a dividend of 40 to 43% of free cash flow. Free cash flow from both analysts and AT&T is expected to be $20 billion. This would mean a roughly $8 billion of dividend payments. This translates to $1.16 per share per year. Assuming that the dividend payments will stay the same up until demerger, we can make some assumptions. So a yield of 8.86%, and assuming the demerger happens in mid-2022, this would mean we'd have 2 to 3 dividend payments left, with dividend X dates in Jan, April and July. This would mean we'd receive either $1.04 or $1.56 per share. So that's the expecting remaining dividend payments from AT&T in its current form, with a drop to $1.16 a year. This would mean a 4.8% yield at the current share price. Now, you would also receive shares in the new company, which is expected to have a share price of around $7. If this was true, the resulting share price of the new AT&T, which will have roughly $7 taken away from its share price at the point of demerger, this will create a post-demerger yield of around 6.8%. Now, all these calculations should be taken with a pinch of salt, as there are so many estimates being thrown around that true figures can be quite a bit off, and I'm assuming the new company won't be paying a dividend in the next few years. So to summarise, here's what you would get if you were to buy AT&T. First, you receive $1 to $1.50 in dividends. At the time of the demerger, you receive shares in the new company worth around $7. And maintain your share in AT&T with a smaller share price of around $17, which will be paying a yield of 4.8% at the current share price or 6.8% at the post-demerger share price. Before we look at any potential valuations of AT&T stocks, we need to consider their massive debt pile. So $180 billion in debt is a huge amount. Their total cash and equivalents is $20 billion, so it's not even making much of a dent in the debt. Now, with a massive debt comes large interest payments. In 2020, they paid just under $8 billion in interest payments. A concern going forward with AT&T is how they can reduce this. It is likely that this interest figure will increase, with interest rates expected to rise in the next year or so. This will put downward pressure on AT&T. As mentioned, they are hoping to move debt into the new Warner Media company. However, this doesn't make debt just disappear, and the spin-off will also reduce their assets, therefore won't make much of a difference to their debt to equity ratio. This isn't terrible for AT&T though. I'd consider their debt to be well covered by cash flow. Lastly, they have committed to reducing their debt. They have proposed that they could start a share repurchasing program once net debt is less than 2.5 times EBITDA. They are currently sitting around 4 times, but will likely reduce at the end of the demerger. Probably the most important question of all, is AT&T undervalued? Well, personally, I think they are massively. Simply, Wall Street has their intrinsic value at a massive $97, giving them a massive 76% undervalued figure. This would mean that if AT&T were to hit the share price of $97, not including any dividend payments, you would receive a return of 320%. If after making it through the video, you are thinking about buying AT&T, there is of course the option to buy now or post demerger. For reference, I currently own shares of AT&T with an average price of $26. Of my stocks portfolio, which has 17 holdings, AT&T makes up just over 6%. I will likely increase this if the share price continues to drop. Assuming the share price stays the same up until the demerger, which of course is unlikely, buy now would give you a stock with a yield of 8.8% for roughly 6 months, then reducing down to a still impressive 4.8% next summer. Buying now would also give you shares in the new spin-off company once the deal takes place. Buying after the spin-off would give you AT&T with an estimated dividend yield of 6.8%. The price for a higher yield is potentially missing out on a high growth new company similar to Netflix. Thanks for watching. Please like the video if you enjoyed. I really appreciate any feedback in the comments. I spent a lot of time on this video and I hope it shows.